Good afternoon, everyone, and thank you for attending this session. We'll be discussing a decision maker's guide to financing arrangements. As mentioned on the video, we'll be offering up to 1 hour of CPE, and you'll just need to complete 3 of the 4 polling questions that will pop up in order to get that. And I want to introduce myself and my co-speaker here, Adriana Ponce. So my name's Adam Hunter. I'm an audit partner with Bekaert. I work in the assurances practice. I've been with the firm now for 16 years, specialized primarily in medical device, life sciences, technology, and professional services with both our public and private practice, both owner managed as well as private equity. And then Adriana.
Good morning, all. My name is Adriana Ponce. I am a manager within our assurance practices. I primarily work in our professional practices department, so our QC side of the house. I've been with the firm for about 7 years now and have experience with both SEC issuers as well as private clients in the health and life science space, as well as professional services.
Thank you. And one point I want to clarify as well, we are taking, or will be Q&A. If you look at the bottom of your Zoom screen, we'll do our best to answer any questions throughout the presentation, but we do have a fairly tight schedule here. But just rest assured that at the end of the presentation, myself and Adriana will be getting a copy of any questions as well as the contact information for anyone who asked those, and we'll be reaching out separately at the conclusion of this presentation. So to go through the agenda and really what is the purpose here, what are we hoping to accomplish? 3 main items really. The first is just discussing some of the common financing arrangements that you'll likely see as a decision maker as you're going through and trying to determine what's the best way to fund your business, fund your organization, to achieve growth, to achieve market development or other sort of goals. Just helping you understand the advantages and disadvantages really of each of those financing arrangements, some of those financing vehicles. We're going to focus more on the business side of the house, not necessarily the accounting side. Certainly these transactions can be very complex from a technical standpoint, but we figured we're a boring one so close to the holidays with all the accounting mumbo jumbo. And then finally, we'll go through a couple of factors to consider in determining which one of these financing arrangements is right for your business. So we're going to start off with just a couple of the high-level items on what are the common financing instruments. What do you typically see when you're going out there and you've made it past your friends and family rounds, you've made it past maybe some seed financing, and you're looking at maybe a Series A or maybe even a Series B to determine how you can get the growth capital needed to fuel operations. The 2 bigger ones that we'll be focusing a lot of our time on today is discussing convertible debt as well as preferred equity. Couple of crucial steps here, kind of the first steps when you're going through this process. First off, fundraising is almost a year-round activity. It's something that typically you're not picking up and putting down at the drop of a hat. So this will be very top of mind as you're going through this process. But you really want to evaluate, with your help in finding the right partners, is first looking at sort of the investment size. If you're going through a Series A round and you're looking to raise $1 million, that's going to very likely be different than trying to do a 10 or 15 or $20 million Series A. Both the players in this space will be different. The common vehicles you'll see will be different, and usually the terms and conditions will vary significantly. Also, in regards to valuation, we're going to talk more on valuation as well, because that's always a hot button topic, especially as you're going through a Series A round. But understanding really what's a reasonable valuation for the company, and what are maybe some of the partners, whether it be angel funding, VC, private equity, et cetera, who plays in that space. And then one other factor to consider that I feel a lot of folks maybe don't give the attention it rightfully deserves, in my opinion, is industry experience. If you're a SaaS company looking to do a $10 million Series A, you're probably not wanting to talk to someone who specializes in medical devices and simply does a $2 to $5 million minority ownership investment. So those are some of the crucial first steps to talk through. And then really another understanding here, just because we want to make sure there's both investors and companies, 2 points of view, two sort of sides. Why do the investors use these instruments instead of just doing traditional, common stock? And one thing that we're going to hear over and over again today really is this concept and idea of risk protection. So typically these investors are investing in early stage companies. There's usually not a lot of traction with revenue or sort of recurring revenues yet to show any sort of, I'll say, appreciable collateral that are securitizing these instruments. So the way these convertible notes and this preferred equity is structured is really to ensure that the investors have some sort of risk protection as they're making this this calculated investment. And the third item, the third financing instrument I haven't mentioned yet is non-dilutive funding. Really going to be focused on the first two because that's probably 90–95% of what you'll see in the market. But non-dilutive funding is always a fantastic way to sort of start maybe bridging your friends and family round, your seed round into your Series A. Non-dilutive funding is really dependent on the nature of your company's operations and sort of the realm and sphere in which you play. Oftentimes, these are fantastic ways to bring in capital, obviously, because in the name implies non-dilutive. As a company, as an owner, you're keeping all of your equity ownership. You're not diluting yourself through giving that away through, at the moment, through preferred equity or in the future via convertible notes. Non-dilutive funding, the biggest thing you'll see in this area really is governmental grants or other sort of charitable grants, depending on what you're doing. If you're in the healthcare, life sciences, technology space, then you have government institutions like the NIH who will often give grants anywhere from, let's say, $250,000 to $1 million. And that may be enough really to develop your black box, develop your proof of concept as an organization, as a company, so you can really show maybe a higher valuation on your Series A. There's other sort of non-dilutive funding, but government grants is probably the most common. There's SBI, SBA, Small Business Association. You'll notice as well has grants that are sort of loans that are non-dilutive. I just want to say that if you are exploring this space, then doing some research on your own, talking to other peer companies, whether it's through a entrepreneurial group or any sort of cohort that you're a part of, is really helpful because oftentimes these are maybe a little bit Byzantine or hard to find, hard to understand. But I do just say, if you're in that space, definitely look around for it because something's going to be out there typically, but it's likely not enough to get you where you need to go, hence the need for a Series A round. And with that, we're going to go ahead and start off our first polling question, which is, which financing arrangement are you most curious about? Convertible debt, preferred equity, non-dilutive funding, or any other instrument that's out there? And we're going to go ahead and give about 30 seconds to a minute for folks to go ahead and answer this. Really want to make sure everyone here is getting the CPE credit that they can for. We'll give it 10 more seconds here. And then 5. Okay, hopefully everyone will be able to take care of that. And we're going to go ahead and start with our first instrument here, which is convertible debt. And I'll hand it off to Adriana.
Thank you, Adam. So just a little bit of a high-level look at what a convertible note is. So it is a form of a promissory note, so it is a debt instrument. It typically is convertible at a later stage, usually at the next equity raise. And then just like a normal debt instrument also has a principal and interest component as well as a maturity date. The unique thing about convertible debt is it has that conversion mechanism, and this is really used to determine the amount of equity that the note holder will receive in the future. The conversion mechanism is typically based on one of two things: a discount rate or a maximum valuation cap. So in terms of the discount rate, we typically see that ranging from 15 to 25% of the next equity raise. For the maximum valuation cap, this is really used to establish the maximum initial value of the company. It's really determining what the note holders can convert their debt into equity. So really establishing a lower price for those early investors is the main goal with the convertible note instrument. Some challenges that typically are seen when we're doing initial fundraising. So a lot of times we see disagreements on an evaluation between the investor and founder. This is typically due to differences in outlook. So if we think about it from a founder's perspective, they're really approaching the valuation of the company from an optimism and passion point of view and taking that into consideration when they are doing the future projections of their company, whereas an investor is more taking a risk-based approach. So the investor is looking to really get a lower valuation so they can get a larger stake in the company for a lower risk, compared to a founder where they're really looking for a higher valuation so they can retain more control and equity in the company that they're starting. So a convertible note can really help us with this challenge, as it's helping defer the valuation of the company to a later date, because the conversion rate is typically based on a discount at that future raise. So it can really help alleviate this early valuation gap issue that we commonly see.
And that's probably one of the areas that I personally see a lot of early deals fizzle out on, is this whole concept of valuation gap. And this is kind of one of the critical pros, I'll say, of a convertible note, is that it really allows you, again, to defer the determination of what that valuation does. It also allows the company to take in proceeds now. Let's say you go and raise a $5 million convertible note. You can use that $5 million to further your product, further your technology, further your R&D, etc. So at the end of that convertible note life cycle, where you are now looking to do a Series B, let's say through preferred equity or other sort of financing arrangements, then there's also the pro that you've used that $5 million to grow your valuation, to grow your company. So it really just helps prevent some of those early issues, especially with regards to dilution and valuation caps.
Absolutely. And with that, I think we have our second polling question. So has your company received investment from private equity, venture capital, or an angel investor group? And we'll give everyone a minute here to go ahead and answer. All right, just a couple more seconds. All right, I think we will go ahead and talk about our next financing instrument.
Thank you, Adriana. The next one we're talking about is preferred equity. And this one, as you may notice from the volume of notes on the screen here, is a bit more nuanced and complex than the convertible debt that we mentioned previously. So kind of contrary to convertible note, a preferred equity is a form of equity. So it does give the investor certain preferences, rights and preferences over the common shareholders. And those common shareholders in this instance are typically the founder or founders, as well as anyone who's come in as part of the friends and family round or any sort of early stage seed round funding. These preferences can include a dizzying array of items. Some of the more common ones that you see here, though, include liquidation preferences, anti-dilution rights, dividend rights, voting rights, board seats, and other sort of items which we're going to talk about. The first one we're going to go through is the anti-dilution rights. And the idea behind this is that you're really looking to protect the investor from losing value in subsequent financing rounds. And the mechanism in which that's accomplished is that really you're adjusting the price at which the preferred stock will convert into common. So what you typically see here, and again, from a legal standpoint, it may differ slightly, but from the brass tacks approach, let's say a company sells preferred stock at $20 a share. So typically it's convertible at a 1-to-1 basis on day zero at $20 a share from preferred to common. And then let's say there's a Series B or subsequent round of financing that's different at that price, higher or lower sometimes. And what it does is whatever's more beneficial, usually for the preferred equity holders, it will modulate or change that conversion ratio. So at the end of the day, the preferred equity holder is not getting diluted based on subsequent financing rounds that do happen. The next one is liquidation preferences. And really what that means is just that the preferred shareholders will be first in line to get paid upon a liquidation event or liquidity event. And that can include items such as the sale of a company, an IPO of the company, any sort of other items where there's a sale or wind up of the business. And typically those liquidation preferences are 1-for-1 on their initial investment, as well as any potential dividends, we'll get to in a second. And then it can also include other sort of multiples as well. So they get paid up to the first 2x or 3x, let's say, of the corpus of the initial investment that the preferred equity holders have. Again, you're starting to see that the big trend here is risk protection. It's mitigating what can happen to the preferred equity holders via the anti-dilution rights, and then giving them that incentive, getting them that return on value and return on investment that manifests through these liquidation preferences or items such as dividend rights. Now, with dividend rights, it's fairly straightforward, but again, typically the preferred shareholder will receive a fixed or variable percentage of their investment. This usually can be, again, based on a per share amount, 3 cents a share, 5 cents a share per year. It can be cumulative, it can rack up, compounding almost, but typically throughout the life cycle of the preferred equity, that number is incrementing of what they're owed based on the dividend rights. And I mentioned previously, these can be subject to liquidation preferences. So let's say the preferred shareholder invests $1 million with a 5%, 10% dividend right, cumulative preferred dividend right. After the first year, you owe them an additional $50,000 or $100,000. And owed is kind of a odd term to use here. Usually you're not paying these out on a quarterly or annual or biannual basis. They're just accumulating in the background. So when you do have a liquidity event, whether through the sale of a company, et cetera, you're not only going to have to pay them the $1 million, but also these accumulated preferred dividends that have been building up over time. And then finally, a couple of areas where we do typically see additional rights and preferences is through more intangible items that don't necessarily line up 1-for-1 with your, I'll say your traditional financial statements. These can include voting rights, board rights, information rights, or any other sort of intangible rights you can think of. I've seen all kind of crazy ones, and really it just depends on what the company, what the investor wants to do. So with voting rights, typically what you'll see is each share of common, let's say, is able to do one vote, one share, one vote. If you have preferred equity, you could have items where okay, well, Series A preferred, Series B preferred, let's say, has 10 votes per share. Or in some instances, you'll see preferred equity that has some truly dazzling, ridiculous voting rights where every one vote of equity is equal to 1 million or 100,000 shares of common. You'll usually see those when the votes relate to specific matters, such as approving a new investor, approving the sale of a company, whether or not to go public, things of that nature, where the preferred equity holder really wants to be able to have strong voting rights, almost veto rights to an extent. The other thing you'll see very commonly is if you go through preferred equity financing is that you'll have board rights. Usually investors such as, I think the lead investors. So if you're doing a $5 million Series A and you have a single investor, a lead investor who's 2 million, 2.5 million of that, they're typically going to want at least a single seat on the board, if not multiple seats on the board. I've commonly seen the percentage be 20 to 40%. So if you have a 5-person board, then typically they want at least 1 or 2 seats. And again, this is really letting them have more control of the company, more influence over the company's decisions, because as an equity holder, which I mentioned earlier, preferred equity as an equity holder, they're an investor, they're an owner, they want to make sure that the money that's been given to the company is being usually safeguarded, spent responsibly, correctly in their mind, and just towards the goal of growing the overall value of the company. You also see other rights that pop up here and there, usually sometimes information rights, i.e. the holders of these preferred shares can, demand to see the books and records of the company. They can look at other sort of confidential or other internal pieces of information. Let's say it's a software company and their technology stack is very complicated. They want to be able to see the whole code base. They want to be able to get into there, maybe have their experts or their folks look at it. Other sort of items like that. But these are really some of the more common ones that you typically see as part of the preferred equity, the deal, as it will. And with that, we're going to go ahead and hit off our third polling question of the day. And that is your company currently raising money in a round? And if so, or I guess, yes, we're doing Series A. Yes, we're doing Series B. Yes, we're currently doing seed or angel funding. No, we're not raising money. Or I guess in the worst case, unsure if you are raising money or not. And again, with that, we're going to give it 30 to 40 seconds to make sure everyone has a chance to answer the poll. We'll give it 10 more seconds for everyone. Okay, and with that, we're going to start going through a bit more nuance, a bit more clarity around these different vehicles and talk about some of the pros and cons of them. For that, I'm going to kick it off over to Adriana.
Thank you, Adam. So let's chat through some pros, starting with convertible notes. So what are some advantages of using convertible notes when we're doing financing? Typically, they are usually faster and cheaper to negotiate and close. They also usually have much lower legal costs because typically preferred stock involves extensive legal documentation. So the lawyer fees tend to be higher on the preferred stock arena as compared to our convertible notes, which tend to have more standardized language. Convertible notes also provide us with flexibility of additional financing, so a company can raise multiple rounds of convertible debt under the same terms. kind of switching gears to our preferred equity instruments. Preferred equity really gives the founder more certainty about their ownership percentage and valuation of the company, as that's determined at the time of investment.
Now, I just want to point out real quick that, again, the concept of understanding that valuation ownership percentage is really one of the critical differences that you're seeing here between both the financing under a convertible note and preferred equity. And that's, again, that valuation gap, deferring the valuation determination, understanding ownership percentage, because when you do a preferred equity round, if you're selling 20% of the company, as an as converted basis, based on those anti-dilution rights and perhaps and other items, usually the preferred stockholders will keep that 20%, regardless of any future funding. And a couple of the items as well, just that were mentioned, was cost and time. So as you're looking at going through financing and closing fundraising rounds, not every company is able to raise money when they don't need it, which is always the best answer. So typically you are maybe a bit over a barrel, you are maybe exhausting or extinguishing the funds you do have on hand. So being able to close on a convertible note in a matter of 2 to 3 weeks is usually a little more advantageous than closing on a preferred equity round, which could take 2 or 3 months. And that's not only because of the costs, legal cost of doing it. A preferred note may have, you have your promissory note, and you have other sorts of security collateral agreements. But when you're talking about the preferred equity, it's a lot more just legal jargon to go through. And oftentimes there's a lot more negotiation, a lot more strife, I'll say, for lack of a better term, where you are negotiating on a valuation. You're getting the valuation done, and then usually the buy-side due diligence is obviously beating it up and kicking it in the teeth. You'll have the argument or negotiations around what are the rights and prefs of the preferred stock. Are there going to be dividends? How many dividends? Are they going to be cumulative? What's the liquidation preferences going to be? Do you want a board seat? How many board seats? Et cetera, et cetera. And oftentimes these conversations and negotiations take just a lot longer. I'll say in every instance where I've seen it happen.
Couple more pros, specifically for preferred equity. It really aligns the interests of the founder and the investors as they both become equity holders when the preferred equity is converted, with the goal of growing the startup. Preferred equity also prepares the founder for later financing rounds where the stakes are higher, including negotiating the valuation and the rights and preferences, as Adam discussed. That's already been done at the time the preferred stock is awarded.
And this is one that I really can't stress enough, especially for companies that are going through their first rodeo of growing a company and being an entrepreneur, is that when you go through a preferred equity round or a fundraising due diligence round compared to convertible debt, I almost want to say baptism by fire in some instance, because you certainly get put through the ringer. For preferred equity, again, that negotiation process can take a decent amount of time. You're asked a whole lot of questions. Usually there is a bit more due diligence, because again, when you're talking about a convertible note versus a preferred equity note, convertible note ultimately is debt. At some point in time, it is due, and whether it's due in cash or maturity, or in equity, that's usually at the option of the holder, i.e. the option of the investor. So they have some protection in that if they give you $5 million in debt and they don't see the company working out, at the end of the day, they have a legal right and obligation to be able to get $5 million plus interest back from the company. So usually the due diligence process is not maybe as onerous as you'll see as part of the preferred financing round. So you do sort of, you learn a whole lot going through this process. you maybe learn what's really important to your company. It's really important to you from a value standpoint. You really need to understand who the investors are at the organization. Maybe you understand which ones you do want to work with, which ones you don't want to work with. Maybe some have some rights and pref that they're not willing to budge on, and that could be a deal killer. You go through just a lot as part of that raise, that due diligence. And I think it ultimately kind of strengthens the company, strengthens your pitch, strengthens your goals in the next 3 to 5 years, and makes it very, very laser focused. Because that's ultimately what comes out of this process. Is usually, what coal turns to diamonds, or the phrase is, you will ultimately have that compression, that stress as part of this. So now we've talked about some of the pros for the founders. There's ultimately some cons here as well, for different kinds of instruments. And I think I've talked a lot about it already, but preferred stock, again, does require some fairly lengthy negotiations. And one thing that you may not realize, especially for preferred stock, is that there's usually consensus among multiple investing groups. Usually you're not just going to go ahead and have a $5 million, let's say Series A preferred round, and have a single investor. As I mentioned a couple of slides ago, you're usually going to have a lead investor. And that lead investor is going to usually comprise, again, maybe 40-45% of the total round. And then they're going to usually bring on their friends. Think of like a shopping out parcel. We have, let's say, a Publix or a Kroger's or a Wegmans or some sort of anchor store, and you'll have a bunch of other small shops, small areas that tag along. That's usually kind of the analogy I see with these investor groups. You're going to have a single whale, if you will, and then some smaller ones. Now, usually, a lot of negotiations are driven by that lead investor and their group, and usually whatever they kind of negotiate on behalf of the entire Series A or B investors is usually what sticks. But there have been several instances I've seen where you may have a single investor at 40% and then a couple more at 30 or 20%, and usually they're not going to just roll over and take what the lead investor says. They're going to want to go ahead and negotiate and understand their own rights and preferences as part of this round. So you're going to have to deal with multiple investing groups, which can be very frustrating at times, circular at times, because one may want one thing, other group may want another, and those can be mutually exclusive. So oftentimes there are instances where some investor groups have to bow out because they're not playing nice between each other, which can be frustrating for you, obviously, going through this process, because that will ultimately, make some setbacks once the other investors want to pony up more money, or they have someone else they know who can step into their place. And again, as part of all that process, you do have this considerable due diligence that's going on. With regards to convertible notes now, as I mentioned again previously, these do carry the risks of default and repayment. Again, this is actual debt the company is receiving. So if it fails to have a follow-on equity round, because again, oftentimes these convertible notes are convertible only upon a qualified financing event or a change in control or an IPO, de-SPAC, reverse merger, etc. Apologies. If you're not able to do any of those, or able to affect any of those in the maturity timeline, oftentimes these convertible notes do have a fairly short maturity date, anywhere from 12 to 24 months. I see it's fairly common. Then at the end of the day, you're going to have some fairly significant debt usually coming due. Now, sometimes the debt can be converted into equity at that time, but oftentimes it's not. And if it is convertible into equity and there hasn't been a follow-on equity round, a qualified financing round, then you kind of loop back into step 0 of this whole idea of valuation. Because without a follow-on equity round, there's really no way to peg the company's conversion rights at that rate with at an actual market transaction. So typically you're stuck then entering a whole new realm of negotiations with these holders. And at that point in time, it can get somewhat fierce. It can get maybe some new disagreements or just leave bad blood all around. So that's one of the bigger risks you'll see with that convertible note instrument. Also, as just going back to some foundational concepts here, preferred debt is debt, preferred equity is equity, common equity, which most founders have, is also equity. So when you have a debt holder via the form of convertible notes, usually or sometimes there can be differing interests between a debt holder and a shareholder. Shareholders are already sort of bought in; they're tied at the hips, let's say. So they ultimately, their interests are aligned with those of the founders because they, at the end of the day, want to have a high valuation. They want to make number go up, we'll say in very simple terms. Whereas the interests of a debt holder, ultimately, they have that ability, they have that escape hatch to be able to say, you know what, we're not liking what's going on with the company. We don't think there's value here. All we care about is getting our money back out plus our 10, 15, 20% interest that we've been accumulating and earning under this note. So they may have the ability, let's say through other rights and preferences that can tag along with convertible notes, to maybe force liquidation of the company's assets, go into default, let's say, cause legal proceedings, make the company choose poor short-term decision making in order to get that liquidity out of the company and get all the blood from that rock. So that's another risk that comes along with the convertible notes, is just that difference of foundational concept. One is debt and one is equity, and those interests oftentimes do not align or will not align, especially when push comes to shove. Again, kind of talking through a lot of these as well, is preferred equity. Again, it's more complex, upfront negotiations, and there is that lock-in of value for the company, which again, loses some of the control that a founder can have, which again limits your flexibility and autonomy to be able to run the business as you see fit. You now have to maybe run some decisions past this new investor group. Now, from the investor side of the table, so we've talked a lot about what's good for the founder or what's not good for the founder, some pros and cons of the instruments. From an investor's point of view, really, why would they favor one instrument over the other? The biggest one for convertible notes is that flexibility I mentioned here, where they have the ability, they have the option to be able to convert that money they've invested into equity at some rate as defined by the agreement, or they can get their money back out, usually with fairly steep interest. Convertible notes are not going to be charging interest you're going to get by walking down the street and getting a mortgage on your building. It's going to be usually at a double-digit amount because they obviously need to show an ROI to their investors. There's always a bigger fish in the pond, you'll find. And then another worry then about the investor. So we said a pro of this is that they have flexibility, optionality. A con is that the convertible notes do expose the investors to more uncertainty and risk. And more uncertainty and risk there are, the higher ROI needs to happen. So that usually manifests its way in, again, higher interest rates, as well as that discount rate and valuation cap that Adriana talked about earlier that controls the levers or the mechanisms in which this debt does convert. Usually you'll find that these valuation caps and these discounts do allow the investors to recognize a fairly hefty return if everything is successful, as compared to a preferred financing round. And another con of the investors here is that they do have less control and information, because I'd walk through those 5 or 6 examples of rights and prefs that exist with the preferred. Those usually aren't as present or as strong as what convertible note holders have. And then inversely, for the investor side of the house, preferred equity does give you more security and protection because you do have those rights and preferences, such as liquidation, dividends, board seats, control, and information. You do have a fixed ownership percentage. Again, when you buy 20% of the preferred stockholder, you're typically going to keep 20% of the company based on the anti-dilution and other provisions that exist. As a convertible note holder, you aren't ever going to really know until an event happens and conversion happens what ownership percentage you ultimately end up with. And one of the cons to preferred equity, beyond just the cost involved, negotiation process involved, et cetera, is and less potential ROI, is that they have less flexibility. Because again, they are locked in as equity holders, and usually they're not able to exit that investment easily. For a convertible note, they can just exit via passage of time. They wait for it to mature, and they have that legal obligation, that legal right to be able to receive the money back with interest. Whereas typically finding a marketable or a market for these preferred shares is a lot more difficult, especially for a private company, especially for one where some of the bylaws or laws of the organization prevent the sale of these equities, et cetera. So we talked a lot about some of the pros and cons here. Ultimately, what are some things to understand and think about? And I think the biggest thing to understand is that you want to really know what are the trade-offs? What are the pros and cons? We spent a lot of time going through those and talking about why someone would choose one over the other, whether you're an investor, whether you're a founder of a company, and understanding the implications of each option. So if you're the sole founder of a company and you really have this vision. You have been dreaming about this, sleeping about this, like this is what you want the company to do, and you think that you're able to accomplish it just with some growth capital, and you don't want to give up any rights. You don't want to have to answer to a board, you have to answer to other people, then maybe you don't want to do preferred equity, or it's just not going to be a good fit to preferred equity, because you will lose some of that control. You will lose some of that ability to make decisions on a day-to-day or strategic or tactical level. Vice versa, if you really don't want to go through the process of long negotiations, or you need the money in the short term, again, that may push you to convertible debt versus preferred equity. So again, understand the implication and trade-offs of each is really critical, and how that maybe interplays with your organization's short-term and long-term goals. You also may just be barred from one or the other if you're talking to certain investor groups. Investors, sometimes will have their own, I'll say, package, their own black box for what they want to deploy capital under. If let's say they're a 10, 20, 30, $50 million fund, and they're doling out $1 million, $2 million at a time, then usually they're not going to want to just negotiate every single tranche of investment that's being deployed to these companies. They may have, all right, here's options A, B, and C, and they're all preferred equity, they're all convertible debt, or vice versa. Choose which one you want to play under, but we're usually not willing to entertain anything outside of these narrow scopes. So sometimes the investors you're talking to limit your capacity as well. But I think even in that situation, it's still important to understand the trade-offs, the implications before you dive into bed with these people. Another area where your hand may be pushed is that not all the time, but more likely than not, convertible debt is usually not present in a middle or late stage company. Oftentimes it's more early stage, again, because they're deferring that valuation discussion. They don't want to avoid the valuation gap, and they want to go ahead and get money on the front end to be able to grow the company, build that valuation, and have a stronger Series A, Series B of, let's say, preferred equity. Now, I've seen plenty of instances where companies have gone through convertible notes at the beginning, They have some preferred equity that comes in, ABC, et cetera. And then some big event happens. Let's say they get, FDA approval of an NDA, or they get really great information on a phase 2 clinical trial, or they've just landed a really great client with fantastic recurring revenues as a technology company. Some structural shift that really changes the valuation. Sometimes they may not want to, if they need to keep raising money, they may not want to go back and rehash some of those valuation discussions that happened as part of the preferred. They want to defer that, in which case I have seen instances where the company is going back to a convertible note. So starting with a convertible note, going to preferred, and then going not backwards, but going back into a convertible note situation, even if it's a middle or late stage company, because there is some sort of foundational structural change that happened that is making the valuation change fairly significantly. Sometimes you'll see convertible notes manifesting in a bridge financing to get the company to a IPO, to an exit, et cetera. So that way they're not locking in a valuation 6 or 18 or 12 months before they have this big liquidity event, this big, like an IPO sale, et cetera, because they think that could hurt the chances, or they could diminish that future value. Ultimately, though, the goal here is to find a win-win solution. Again, you're really looking to align the interests and incentives of both the investors and the founders, because this is a fairly serious relationship that you're entering into with your investor, and you want to make sure that there's a right fit and finish. So you're both aligned, from a size perspective, an industry perspective, a short-term, long-term goal perspective. Sometimes if you enter into an arrangement with someone who's looking for a flip of the company in 2 years, that may not align with what you're looking to do with the company in that time frame. So ultimately, when you align these interests, it's usually best for everyone involved, is the frame. And I know we talked about a lot of items here. I'm not going to go into this slide in exquisite detail, but I do just want to call out some of the items to consider. Again, summarizing this a bit more. So the very first one, I think, for transparency and certainty is that valuation. Again, preferred stock, when you enter into that arrangement, you are making an evaluation decision then and there. You do need to understand who's going to own what and what percentage, and that requires evaluation. Whereas convertible notes, again, there's usually not a formal valuation that's done. There's not that valuation gap you have to bridge. But on the flip side, the ownership percentages are usually less clear. Again, preferred stock prepares you a lot more for future financing rounds. You can kind of go through that baptism by fire. That's part of the due diligence. As I mentioned, some investor preferences will drive this car. You may be dealing with someone who only does one instrument versus the other, in which case you're not really going to have a lot of leeway or say in making those decisions. From a speed perspective, preferred equity takes longer, convertible debt takes shorter in general. And corresponding with that, the longer negotiations take, the more expense you're going to incur, whether it's through negotiations with, through a broker, or going through legal costs. Just the sheer cost of drafting all the documents, it's going to be more expensive to do a preferred equity round versus a convertible note round. And one of the good things of convertible debt then is that, from a flexibility perspective, once you've gone ahead and done that the convertible debt terms, usually you can copy and paste that into multiple different investor groups, multiple different deals. So you can have a series one, A1, A2, A3, where you don't have to go renegotiate all these. So the incremental cost of doing all this is less. Again, preferred stock is more difficult to negotiate because there's a lot more just things to discuss. There's more rights and preferences to discuss, valuations to discuss, etc. And then finally, preferred equity, as I mentioned, there's more control, more influence that the investor has because of, let's say, those board seats, let's say the voting rights, information rights, etc. Whereas convertible debt, usually the investors are along for the ride, and they don't necessarily have that control or ability to change your influence. With that, I'm going to go ahead and kick off our fourth and last polling question. And it's just a question everyone out here. Would you like help in navigating future funding vehicles? Yes, no, or maybe in the future. We're going to go ahead and give that 30 seconds or so everyone can answer that. And again, get the CPE that you want. Okay, and with that, we've gone through the presentation. We have maybe a couple of minutes for questions. Adriana, are there any questions that you think we can answer in, let's say, 1 or 2 minutes? If not, then we can go ahead and just wrap up the presentation for today. And like I said, we'll be seeing the questions afterwards, and we can reach out to everyone individually.
There's just one question, but I think we can handle it afterwards.
Okay. Great.
Thank you all.
Thank you all for attending. We appreciate it. Again, my name is Adam Hunter. I'm a partner here at Cherry Bekaert. Adriana here is a manager who works with me as well. We handle fairly complex financial instruments and arrangements. As you can see here, each one is maybe a little bit unique, like a snowflake. If you have any questions or want to learn more or understand what we discussed, then please feel free to reach out to either one of us. Our contact information is here on the screen. Never too far from email, much to my wife's chagrin. And then we also have LinkedIn or other ways you can reach out to us. Looking forward to talking with all of you in the future, and you have a fantastic day. Thank you.